Good morning, Guru.
Good morning, JTW. How are you?
I'm doing well, sir. How are you?
I'm excellent. I'm excellent. I like I mentioned earlier in our pre-show, um, I'm so happy that kids are actually going to school this morning. They were meant to go out yesterday. We had a snowstorm that kept them at home, and yes, we're going back to in class for them, which is great from because school from a distance for a 6-year-old is not really happening. Well, the older kid, bad, but, for a 6-year-old, and it needs constant attention and stuff. We have, Double O 007, this morning, and we have a special guest, a Duke ball fan, 2011. I don't know if you guys have been, following chat lately, but, came across this guy, and I'm like, "Okay, he knows what he's talking about," and I really like that. I like to challenge a few things, and he had very, positive answers and knowing what he was doing. So we welcome you, Duke ball fan. Thank you very much for accepting the invitation.
Yeah, thanks, man. You guys can call me Kyle, but I've been doing this for a little bit now. I'm an attorney after I left this world, which is less lucrative than trading. So I would advise all of you not to become attorneys. You'll be miserable. Um, but through my work, I get a pretty good insight on what a lot of the larger banks are doing internally, and that's obviously very helpful for some of the macro trends here. So I am more than willing to offer up what I'm hearing back when I hear it.
Awesome. I believe you've been around a little bit, right?
Yeah, like 13 years. I started in investment research and was an analyst for an independent company, and went and ran trading for a small fund. I was managing like 35 million, and did some private equity stuff for a couple of years, and then finally ended up in law doing mainly mergers and acquisitions. Kind of been a weird path to get here, but I've gotten to see some markets that aren't you know just all buy everything every day type of thing, and I think that's going to be valuable in the next couple of years.
Yeah, well, you were mentioning pre-market or pre-podcast, I should say. We're still in pre-market. That what you're seeing currently in the markets is kind of reminiscent of what you saw in 2015 with the market. So you want to kind of, I thought that was some really interesting points that you made there that I think would be good for everybody else to hear if you want to kind of recap those things again and you don't mind repeating yourself a little bit.
Yeah, so there were some common trends in 2015 that I'm seeing now. It was coming out of 2013, 2014. A lot of you guys will remember that basically the hot thing at the time wasn't big tech or kind of speculative tech, anything like that. It was individuals were pumping money into micro caps and small caps, and they were running almost every day. And then 2015 hit, and like this year, everybody looked forward and said, we don't really see that much um, growth in the markets in the next year or so. And there was some Fed uncertainty, which caused some of that. Uh, and it ultimately ended up playing out, and everybody was fine on the other end of it. But in the meantime, if you were day trading or kind of a shorter term trader, there was a lot of chop, and the chop was different than anything in the prior years, um, and that was a hard lesson for a lot of people to learn. Um, and I think the relationship here is you've got a year that we're down negative, and we haven't seen a year where we started out this down and really, since the onset of the beginning of the year, stayed down um, like this, and it just creates a different environment where the bias, if you will, is kind of sell the rips until proven otherwise. The farther we get away from the year's open, the more bearish it is. The closer we get, the more likely it is to retest the highs, which sounds very, very simple, but at the same time, it doesn't mean, oh, we started moving up a couple points, we're going to go back to the highs. It kind of means manage your risk, because there are days that I think we're going to see this year that we open up to pretty significant downside. Today is a good example of that. And before, with an elevated VIX, what you've got to take into account is, first off, rips are going to sell a little bit more. And the other thing is option premiums are going to get more expensive, because there's a larger measured move, if you will, based on the VIX being elevated. So it makes it a little trickier to, with where you're needing to get in on options, makes it to where you need to be a little more selective, get the best pricing you can, because it's not going to be, every day at least will not be a, buy anything. And if you're even close to right, it'll work out. This is kind of a, we're traders and we have to trade, but we've got to be more selective.
If you guys were in chat with us last night, we were talking about last night the 10-year was jumping high to 184. And we talked about the relationship with China, the Asian market, and whatever is happening regarding supply, demand, the control over the renminbi, the yuan, which is the Chinese currency. Can you elaborate a little bit on that and how it affects the current situation?
Yeah, I mean, this is one where you've got to stay apolitical. I would compare this to practicing law. People ask what my political affiliation is, and I ask them which county I'm in, because here the judges are elected by the people in that county, and it doesn't afford attorneys the ability to have a bias one way or another. Otherwise, you're going to have a hard time. It's similar here, because whether you like China or you don't, there's two things that are very, very clear. One is that they are willing to devalue their currency. Part of that's to stay competitive, and to try to push the U.S. on its own currency and put some pressure there. But the other side is China instituting more basically stoppages at its port under the guise of COVID right now is only going to add to the inflationary pressure in the U.S. And so you see that reaction coming after that announcement on Friday. The bond market wasn't open until last night, and when it did open up, or I guess after hours opened up on the 10-year, you saw a huge jump. And that's not, that's a reversion to what the 10 years pricing probably should be, which is a little bit higher than here even. And a large part of the reason that it stayed down is because you have out of what the Fed's buying currently. Yes, it has cut back on overall spending per month, and it's wrapping that up. But in the first cut, it actually cut mortgage-backed securities and increased the amount of treasuries it's buying. And at some point in the near future, the Fed signaled in the next 2 months, it's going to wrap up all of its purchases, which is going to cut down on demand for U.S. bonds. It's currently hovering anywhere between 25 to 50% on any given bond issuance. Is actually the Fed buying our bonds, our 10-year, 2-year, 30-year, treasury bills. And the result of having that much demand go away really in 2 months is going to be that the 10-year should you know start to see a drastic increase. Demand for treasuries drives down the yield. So slower demand means higher yield. And so we at least right now, we can only go off the data we have. We have to plan on there being a higher 10-year even from here. And that means that risk assets, things that are more growth oriented and less fundamentally balanced on earnings, like the Teslas of the world and a lot of the larger tech, as well as the some of the other hotter areas of the market, are going to necessarily have to cool off because even a small percentage rise in the 10-year takes an enormous amount off of what the pricing is for those assets when it comes to the larger banks and everything.
Because now explain the reason why all this tech pressure is going to be felt if the rates are going up. Is it because
when
ahead.
you're looking at discounted cash flows and everything else, when you're looking at the financial modeling of these assets, these riskier assets, you've got a planned and risk-free rate, which is the 10-year. If the 10-year is at 0, then you have basically a higher you have less that's discounted off the price, and that's a exponential discount. So you say, okay, it's only 1.8 right now, but that's 1.8 expanded across as long as the multiple is for that asset class. So like for Tesla, trading at 100 times earnings, it has a much larger impact because it's projecting out longer growth than it does, for instance, a company that's a little bit, priced in a shorter term, like Apple, who's even out at, 25 or 30 times now. And the difference is that it has less of an effect on Apple than it will on Tesla. And it has more of an impact on Zoom, or it has, basically anything in the ARK ETF than it will on, consumer staples or something that tends to trade at a lower valuation. And that's all part of the rotation you keep hearing about. People are rotating into what they say is value. I think that it's actually because there's so much money in the plumbing right now, they're plugging into larger companies. I think eventually it's going to trickle down to where you see the Russell 2000 and some of the smaller value names that are trading at a fraction of the larger cap value names. And I think you'll end up seeing a good amount of rotation there. Also, from what I've heard from JP Morgan, BAML, and Morgan Stanley, each is that they see biotech as being one of the places they're looking to rotate money into. And the reason why is even when you have inflationary pressure, there's still a search for yield. And one of the places that's been beaten down recently is biotechs, and biotechs have a higher yield. And so the thought is that they'll kind of replace some of the risk allocations in a lot of these larger portfolios, because the companies that are valued off just earnings growth are quickly becoming less attractive.
Now, I'll be the devil's advocate here. We all know that Tesla has been trading a lot higher than its earnings, and people don't seem to care. It looks like it's like a fad, or basically what Apple was in the beginning. How do you counteract that? I mean, a lot of people will dive into that long, even not looking at their spreadsheet at all. How do you counteract that?
Yeah, so you've got to look at a couple things. First off, a couple years ago when that happened, it was a $100 billion market cap, which meant that on the public float outside of institutions, there maybe was half a billion, or half of that was actually what the public float is. So we'll say $50 billion. So if you have a lot of individuals rush in, no matter what the pricing is, they can drive the stock up. Right now we're sitting at closer to $1 trillion, which means it takes a lot more money and a lot more institutional money in order to create large price movement. On something like Tesla, I've got puts on Tesla from Friday coming into today because I thought that we may have this move. I don't think that that's necessarily the greatest thing to rush out and try to play the downside on because, like you said, it's been a very tricky trade. I think I've gotten short on Tesla 4 times in the last 5 years. It's not something that I look at very often. It's just a good example of a company that won't do as well in a higher interest rate environment or do as well. And that's what you're seeing this morning, it being down, close to 2.5% when the S&P is only down 1%. So it's much less of a don't do this or do this related to a company like Tesla, which is so driven off this fad. It's more of, maybe isn't the best time to run in and play YOLO calls on every single dip, at least not yet this year. Not saying you can't make money. It's just not a great risk reward anymore.
And you're not talking about Tesla. You're talking about the market in general.
I'm talking about risk assets. So anything that's at a higher multiple that's based on having great growth, I think is in trouble. And that it connects to, in a lot of ways, to what we're seeing in consumer sentiment and consumer spending. Sentiment goes before spending goes. Sentiment has been really in a bear market for the last 6 months for consumer spending, but the spending numbers haven't shown up that way. They've looked a little bit weak, but they haven't shown full on this is bad. The U.S. is a consumer-based economy, so if you have a consumer that's not doing well, even something like Apple that has products that virtually everybody uses isn't going to do as well if the consumer is not spending as much money. And right now we're at pretty substantial margin debt and credit consumption for consumers. And so without additional policy being put in place, it's hard to see where the next kind of inflows will be to the consumer, and that takes away money that can go into those risk assets. And it takes money that's going to go away from earnings for a lot of the larger tech and like I said, the overall market. So it's not saying we can't have the Senate turn around and pass another spending bill that injects a bunch of money into the economy. It just means, as we stand today, there's not really a good direction for where the next inflow is going to be.
Now, for the coming weeks or coming days, let's start with days and then coming weeks. What would be your best suggestions towards new traders or even long portfolios? How would you manage that?
Yeah, I think if you don't have a position coming into today, especially on shorter term stuff, I would watch the market for this morning, especially for the first couple of hours, and sit on your hands, because we're going to open up with option premiums being through the roof, with the VIX up as much as it is, and you're not going to have great risk reward on buying anything at the open. That being said, there's levels we could pull back to in the S&P here and bounce off of, at least short term, that would potentially provide some opportunities. But I don't think you rush out and buy puts. I don't think you rush out and buy calls. I think this is a day where if you didn't catch the move, that you've got to kind of watch it play out and things settle down. Either watch the VIX come down, keep an eye on the 10-year and see if that is able to breach. Looks like it's had support at 1.81. And so if it falls below that, the VIX starts pulling back, it's a possibility that you can, basically buy puts on the volatility index potentially. As far as data goes this week, we've got, we're really coming out of a period where the next couple of days, there's not going to be a ton here. There's a lot internationally. But it's all gearing up for, the monthly expiration, as well as, all the data that does come out is going to be looked at as far as what's the Fed going to do based on that. So it's really hard to say, what that data is going to end up being and when it's going to turn to be bearish, and how the market's going to treat it outside of a day-by-day basis. So there's not, if anybody comes out and says they know where the market's going to close this week, they're lying to you, because no one knows. And I think that you've got to approach it as, how are we set up for the next day? Let me position for that. It's either going here or it's going there, and making sure to have hedges in place if you do play something overnight. And then in the intraday trading, I think you've got to be pretty flexible on what you see. Stay off of CNBC. Don't read whatever the Market Watch news is that they march out, because they'll come out with an explanation for everything. Watch the inflows and outflows from the different stocks and the market as a whole. I think you do have too much macro going on in the markets right now to not look at what the broader market's doing, because it's awfully hard for a company to run when the Nasdaq's down 2%, for instance.
And there's a big weight on the market reporting starting this week, but next week as well. I mean, we have Netflix this week, but next week we have a huge S&P 500 weight, and Microsoft is reporting, Tesla is reporting, we have Apple, we have the oil industry like Chevron and the lots. We have Boeing. That's all next week. And the following week, we have all the alphabets, which is Google. How do you deal with that? Usually there's a ramp up towards earnings. Maybe now, like you're saying, a lot of people will be a little bit cold or maybe on their toes waiting to see what happens. Do you think it's going to be priced in? Do you think it's going to stay flat? Like you're saying, I know you just mentioned no one can predict what the S&P 500 is going to be closing on Friday, but knowing that maybe 20% of the S&P 500 weight reports in the following weeks, in the next 2 weeks, how do you plan on ahead for such a move?
Yeah, so I think a couple of things. Seeing a weaker consumer, a weaker Black Friday, things like that. I would suspect that earnings coming in were supposed to be great, and I think that has the potential to disappoint. But I think the bigger thing to look at is what the companies are keying on. There's always themes, especially when the market's going through something, that the bigger companies will all mention. Whether it's Omicron or whether it's inflation, if you have higher inflation and every company comes out and says it's higher inflation, it's going to cause price pressure and, affect us in this way, or they're not going to, not willing to, put out forecasts because they're not sure what the market's going to look like in a couple of months. Those would be things that I would watch for that would be worrisome. But I think that you also have there's a couple of, you want to see how the market's priced it in, I mean, go look at the price of Netflix. Just pulled up a daily chart of it, and we're down almost in a straight line from 700 to 500. So while normally, if we were at 700 right now, I would say, guys, this is a very easy, buy put spread, sit back and watch it. And right now it's trickier because I anticipate that there's going to be some concerns. You don't have as big of an Omicron fear, so you don't have as much of a stay-at-home play as you would have normally, which would have been a boost for someone like Netflix. But at the same time, they're priced now at literally 30% below where they were a couple months ago. And so the question is that enough? You kind of have long-term support here. I anticipate that you're not going to have a lot of movement unless there's something crazy that comes out on Netflix. Or if you do, it may be maybe to the upside just because of how much selling you've had recently. So I'm not sure that's one of the better ones that may have better risk reward as far as playing its earnings. Some of the others like Apple, I think that my fear is that you start seeing some of the consumer data that I'm seeing start popping up in earnings. And there's definitely been some concerning things out on Apple over the last 3 months. And, the market's reaction has been to squeeze out every single person that bet against them. So it's really a very tricky environment right now. It's very easy to lose money, and it's going to be a lot harder, especially in the next several days, to make money with all of these dynamics going on.
Now, thanks for sharing this risk on situation. We've had, and if we look at the S&P 500 chart for the last weeks and months and almost like a year, it's a constant rise to the upside. So it, like you said, it's when we start moving down, it's not a matter of when, but how to gauge it. And we've been trying to show everyone this channel that we've been in a weekly channel, and JTW has been great about sharing that. And as soon as we start losing that channel, obviously it is what you're actually suggesting is we might lose that 458-ish line, and then we have more risk to the downside than reward to the upside. So thanks for sharing that with us.
Yeah.
And I think it's not full on risk on yet, but be very cautious that we're around key levels here. And you're right. I mean, we're maybe 0.5% away in the S&P from where it's currently trading pre-market, from where it gets a lot dirtier, because we can either flush through these levels and snap right back and continue higher and squeeze everybody out that got really short, or it's going to flush and continue to go. I think the idea is you don't have to be bearish on the overall market to recognize that it's going to be choppy. And choppy destroys day traders if you're not protecting yourself against it, because this is an environment that anybody on here can be wrong on any given day. And if you're too exposed, that's a problem. So I think it's taking down exposure, taking up the hedges on your trades, which all of us can kind of help out with, while still trying to participate in the market where you see spots. Ultimately, this market will make you a better trader anyways, because getting more selective in everything, you'll have a whole lot more winners and a whole lot fewer losers, and your losers won't be a huge account drawdown. So long term, I think this is probably good practice for everybody anyways. But yeah, it's the only thing that's clear is that there's not a clear picture, and that means that you're going to have a lot of market volatility.
And I think we talked about it last week. The VIX is built from, basically, it's an index from how much the monthly puts on the S&P 500. And what is Duke is suggesting is this: whenever the VIX is moving higher, chances of the volatility is higher, and when volatility is higher, chances of the S&P moving in one direction or the other becomes higher. And this is what makes the premium go higher. So basically, you're paying for something, for a movement on the SPY, or SPX if you're playing the SPX. You're paying for a movement that is great. The premium is higher basically because they're expecting a movement that will be greater. And if it doesn't move, basically you're paying too much for your premiums. So sometimes, like Kyle is saying, basically sitting on your hands and being more uh, selective on your on your ticker will make you a better trader. And I totally agree with that. Thanks for sharing that with us. It's also a good time, I believe, to watch the general overall strength of your ticker as it compares to the market. If your ticker is moving higher and the market is either going sideways or down, basically it shows strength in your play. And that's one thing to watch for. So keep in mind that.
Yeah, the best thing on individual stocks is to watch money flow and watch the size of the movement. That you can get breakdowns on different trading platforms. I know, but what you're looking for there is, do you have deleveraging by bigger money? And a lot of times the market will move up as bigger money's, deleveraging, and that's what we saw, kind of in the bounce on Friday. You saw net outflows in a lot of places, but the market moved higher, probably to screw options because they're evil like that. Don't like paying out money to us. But that being said, it projects really what the following days are going to look like because, your prior day's trading established where the volume support and resistance levels are to a large part. So we're not talking about looking at trend lines. We're talking about where's the money at, and the prices move between where there's low resistance. Sometimes that's to the upside, sometimes that's to the downside. So the easiest way to get the inside baseball on what's going on is try to see what large money's doing. And I'm not beating up on Tesla. I'm just this is one I've looked at recently. You look at some of the outflows that you've seen with even institutions like ARK selling positions in Tesla, which I believe they're really just taking profit on when they were trying to support the dip around 600 and they bought a lot. So I anticipate they got into a larger position than they wanted and they saw higher prices and wanted to take some of that off the table. It's not a full on, everybody's dumping it, but if you start seeing, insiders selling things or you see funds that are trading out of something, which I think we'll see a lot of rotation today and a lot of rotation tomorrow, it's good to find out what those sectors are. Because you saw, several months ago, like rotation into energy because of the price of oil. If you get in on the front end of that, then there's great returns to be had. And the only way to see that, they announce it, that there's a rotation there a couple months later after they've already bought position. So it's always good to watch volume and always good to look at the quality of that volume as far as what it's telling you. Because it's a lot of these larger stocks, I mean, someone getting out of $1 billion position does have a huge impact on the trading price that day. Sometimes you see something and you don't understand why it's going down. It's just someone is taking something off the table.
Now, do you have a watch list? Do you prepare for each morning? How do you do that?
So I've gotten to where I'm primarily trading off, starting from the macro and going down from there. So I look at what I think the market's going to do. and I look at what, based on the 10-year and the dollar and everything else, how it's setting up and how the data I think that's going to come out is going to affect that. And then I go from there to look within the sector. So like right now, we've got the 10-year elevated, we've got the VIX elevated, and coming into today, I had SPY puts for today's expiration because I'm a little bit crazy and for whatever reason thought this move was pretty likely. But what I'll probably do today is I will wait and see what the overall market's reaction is and sentiment to this, and then I'll start building a plan off of that. So I'm pretty reactionary as far as what I see on a day-to-day basis. As far as sector goes, and like I said, from what I've heard, biotechs look like they're going to be good longer term this year, and I think that you've got a lot of catch up in the microcap space where you haven't seen much price appreciation in the stocks in a couple of years. So, for instance, I'm looking at two that are I think are very undervalued right now. One's MTBC. That one you can just go kind of look at its earnings, and it's pretty straightforward. The other one is VAX, VAXX, which is an IPO in November. And I actually know some of the guys at the company, and looking at the data and everything, and what the banks are pricing them at, it's their closest price target's 200% from here for a reason. And I anticipate if they were trading better when they got their buy recommendation on that, the price target would have been higher. But banks don't like to get ahead of where it's currently trading. So that's one of the ways that I, even if I'm going to sit on my hands on options, and I think the market's going to go down, I'm going to go look at places where I think the rotation is going to go into, because like you said, those are the stocks that are going to hold up better. Because markets aren't completely efficient, but they tend to, if you have something that's priced well, that has good future expectations and everything else, that's trading below where it should be priced, generally those things will over time correct themselves. So it's a matter of trying to pick out, okay, what do I want to stay out of today, and where, if I'm staying out of this because other people are staying out of it, where's that money going to go to work? Because it'll go to work somewhere.
Are you guys taking notes?
Yeah, I think Kyle makes a great point today.
Ask anybody that's messaged me. I think I've answered every question anybody's ever sent me. So you guys can send me messages and tell me how I'm crazy or wrong about something, and I'll gladly sit there and talk with you about it. I think that the best thing that a group like this does, and the reason I came on board was, no matter experience, the more views you get, that you're kind of looking at yourself and trying to let them play devil's advocate or propose other ideas to you, makes you a more, it makes you a better trader, but really what it does is it expands your worldview, because we all have different perspectives and see different things. It's funny. It's like my grandfather didn't have a high school education. He was great at long-term investing, and I one time asked him, and he looked at me and said, "Well, I always go there and it's always busy, so why would I not buy that company?" And it sounds dumb, but that's what drives markets. And if you get enough people together that are from all over the country in all walks of life, you get a more complete picture of what our economy looks like at the time. Because you may think everything's terrible in California, and people in New York may think it's great. got to take that into account.
I know 007 is doing that. He's going around the country and he looks at every door and he looks at everything that is busy and he takes notes of that and he shares that with us.
The way.
This is the way.
That's the
Yeah.
way.
Yeah, 007 is really thorough in what he's doing. He goes deep into all these companies and pretty much, I mean, he's overeducated, I would say. Not under, but overeducated. And then he educates us quite a bit. And we've been saying it, there's more than one recipe that works, and it's finding your own recipe. And I think, and Kyla, what you're doing this morning is sharing us a way to find a recipe that works for each and every one of us, making sure that we keep in mind the basics of the of trading. So thanks for sharing that with us.
Yeah, and I'll tell you a way that I was big time wrong, and I'm still big time wrong, that my wife makes fun of me about. She's an attorney too, and does I think she published like one of the first papers on crypto regulation. Knows everything about crypto. And I think crypto is a gigantic fraud, and you can't convince me otherwise. And I'm completely wrong on that, and I accept that I'm wrong on that. But that's a matter of there's different perspectives. It's something that everything in me and all of my experience says this is a bad idea, and yet there's a lot of people out there who have made a lot more money than me, doing exactly what I would have said is a terrible idea. So, even if you don't agree with something, your opinion matters, because no matter how much experience whoever you're, on the other side of, on any given day, you could be right. So it's really about being open to different ideas. And like I said, this year I think is going to be very much on everybody kind of sticking together and trying to figure out the best plays, as opposed to there's 45 different things that you could run out and buy calls on like you could last year, which I was doing as well. I mean, don't get me wrong. I'm not, bearish on the United States or anything. I just see what's setting up in front of us as being a much more difficult market to win in. Part of the reason is we have elevated option buying at levels we've never seen before. And at some point, in my experience, institutions have always let retail make money as long as they decided to, and then all of a sudden they flip the switch on them. And I'm not so certain we're not going to have a bunch of periods of increased volatility followed by just volatility crushes. And a good rule of thumb is you leverage up and buy more options when the volatility is lower, when you see that risk of a downside isn't priced in, or risk of a big move isn't priced in. When the VIX is elevated and the data is showing you that things aren't as bad as it shows, to fade the VIX and go long, but knowing that your premiums on going long are going to be more expensive. I think if you're not following the all of the different indices and the VIX and the 10-year at this point, at a bare minimum on your what's going on in the market today, you're being pretty risky in and of itself. So that's kind of my advice is focus, watch the macro a little bit more this year. I know it hasn't mattered before, but it is going to start to matter.
Yeah, I think those are good points, and I think macros always matter. It's just that we have so many new people in the trading industry now that people kind of got away from the fundamental aspect of things, and it's finally starting to come back a little bit. We're seeing a lot of stocks coming back to valuation, even things like Affirm that just things that were crazy price to sale ratio, price to earnings ratio, where we saw things went crazy last year, but now a lot of those high PE and high PS stocks are finally coming down. And you see things like UPST, Affirm, and so many others, man. A lot of the small caps as well. And I think that's a good point that you're talking about, like watching their environment. I always tell people that, the market, the S&P 500, the the dollar index, financials, those things are almost like the weather. If the weather is bad, everything else could potentially get hurt, and that's like the S&P 500, right? So that's why usually every week I usually try to post, like every Monday I usually try to post market outlook in our elite channels to kind of give an idea of where I think the weather is going this week. It's not always right, but it hopefully that helps people out a little bit more.
Yeah, and I mean that's a good point. I mean, to use your analogy, the weather hasn't mattered that much because if you're going to snap back the next day from whatever selling there is, the individual stocks themselves haven't. You still have winners on those days. If we get to where there's sustained selling pressure, and you're going to see markets kind of indiscriminately move together. There's still going to be some rotation, but it'll be more muted as the trend continues. So until we get a reversal of this trend, I would plan on needing to look at the weather. You get back towards all-time highs, and a lot of it is just sentiment driven, and if nothing bad or if nothing terrible comes out in the market, does it force it to look at it? Markets will in large part ignore it, and the best way to see that is the Trump-China trade war. Yes, it looked bad. Yes, it had very large implications, but they were down the road implications, and the market was at all-time highs, and so it wasn't being forced to deal with the issue. Now with what the Fed's doing, we're being forced a little bit more to deal with the issues in front of us. And I think that's the critical difference right now, is that some of these things that we've been saying would blow up for a couple of years or could blow up, now they have to resolve one way or another in the short term, and that creates a lot more volatility. And I talk to people at the different banks all the time. The one thing that they don't have clarity on at the lower levels is what the Fed's going to do. So I can't really help with that. That one is, the Fed does meet and talk with all the big banks and everything, but that's a close held secret at the top, what they're going to do. So you can't ever guess what they're doing because people at the company that have the information of what they're going to do don't know what they're going to do. So
Yeah,
any uncertainty causes the I guess the bias to be to the downside, and as you get more certainty, then obviously the VIX goes down and the bias turns the other direction. So
yeah, I think those are good points. And also, like you said earlier about the crypto stuff, that the market is also largely driven by supply and demand. Buyers and sellers, and the more buyers coming in, the more momentum we can get, and the stock can go higher. And I think something that's really interesting with that is also Activision today being acquired by Microsoft. Did you guys hear about that?
Yeah. Oh yeah. Yeah. It's up 36% or something like that this morning. I maybe accidentally kicked the hornet's nest by mentioning it in the options chat this morning, because then everybody's like, "Oh, I'm going to play puts, or I'm going to do this. I'm like, they've settled on an agreement to buy it at a certain price per share. Like, now is not the time to play puts."
Yeah, I would not play puts on that.
You say that, but a lot of times those things will run past what the pricing is. It's hilarious. So if it does run up,
that's always
pricing. Puts aren't a bad idea. I mean,
yeah, if it got way up under 95,
see it going up. They don't do the research to find out that what number it's actually going to go bought out at.
Well, this is actually Microsoft is looking to acquire Activision for $95 a share in an all cash transaction, right? So usually when the all cash transaction means is that there's almost no like not much volatility in it because they're guaranteed to buy in cash. And usually when they set these deals, and you say you work on the other side too, so when they set these deals, there's a huge penalty. And for this, there's $3 billion penalty if the deal doesn't go through. Now, playing puts on it later on at some point or another might work because, there could be an antitrust issue or something like that that could prevent the deals from going through. But playing puts on it right now, I don't think that's necessarily a good idea because usually on cash deals, I play merger arbitrage a lot, and usually on cash deals like this, it's a pretty solid deal.
Yeah.
But I think what
Yeah,
this also
if
give us an
anything, I would be
idea of
buying dips because
is,
it's below 95. And
huh?
buying dips would be fine. Options are going to be priced in almost to perfection because it's a all cash deal like you were saying. But if you want to buy the underlying stock, if it's trading at 87 and the deal's at 95, I can tell you as an attorney, I can't really think of what the antitrust issue would be there. If Amazon and Facebook and the rest of big tech don't have antitrust issues with some of what they've gone into, I don't think
Yeah,
that
I
this
mean,
one's going to have problems.
I'm just saying, like, that could be a possibility. But the other thing that I think is really interesting as well is the fact that why they're acquiring Activision. They released a little statement. They talk about, getting more into this gaming space, mobile gaming space, and particularly possibility of like going into the metaverse, industry. And you guys know I'm pretty excited about that. So I think that's gonna be very interesting for the sector of the metaverse. We could see a lot of those other stocks starting to get some rotation too and some hype. So maybe like Roblox, it's already started moving a little bit this morning. That was something I got into on Friday. I was pretty excited about. And I think that's still like something we could potentially see money go into as we see more and more companies making these acquisitions going into that industry between Take-Two Interactive acquiring Zynga and now Microsoft acquiring Activision. So I think that, and even Walmart over the weekend. I don't know if you guys saw that a little bit.
No, I was going to say on Activision though, with like we've been saying, the 10-year elevated and the VIX elevated, that a lot of the metaverse related companies are pretty richly priced here, based on what we think is going to happen with the metaverse, which I would agree. I think it's going to be big. Who benefits from that's a question, but with that in mind, that's one of the ways you've got to watch the weather because today it may not be the best day to run out and buy calls. Tomorrow, maybe we get to settle down and, those stocks held up, but they didn't really move that much. And then the market, holds support here. Then you could see that as being a potential very good trade. One of the ones that I'll tell you I watched last week that I thought held up extraordinarily good is DWAC, DWAC. It looks like it's actually running right here in market, with the market selling off. Now, I'll tell you that when the trading slowed down a little bit during the day, it tended to sell with the market on Thursday and Friday, but it was holding up better than other things, and it was bouncing back anytime the market tried to bounce. So if you're looking at a good call play, I say wait to see if you get a dip on DWAC and look for calls that are even this week out around 75 to $80 to be priced well. From that chart, I was actually looking at last week for potential for a breakout to around the $88 range. So we're kind of in this place where we take out 75. I think we go quite a bit higher pretty quick. And that one, being a cult stock like you've described, will probably hold up a little bit better in a kind of more volatile market environment. And it's smaller, so there's not as many institutions that are going to be deleveraging and things like that. It's really a bunch of retail. So if retail's still bullish on it, no matter what the market's doing, that one has a lot of potential to go higher, especially if the market bounces at some point.
All right. Well, we're about 2 minutes from the open. Kyle, really appreciate you coming on and kind of sharing your experience and some of the insights that you've got. I would call privileged access to to a certain extent, and definitely the experience and background that you bring to the table. It's always good to kind of get that macro level perspective from somebody when it can also be very easy to get kind of focused on the more intraday, intra-week moves. We also have to take into consideration what's the bigger picture looking like.
Well, and when we're shopping billion-dollar deals to different institutions, they have reasons to be nicer to you. So like I said,
That's a fact.
I've got several of the individual fund guys over there that I'm friends with, and they give pretty good insight on what the institutions are looking at. Sometimes I choose to ignore it. Sometimes it is more important than others. Right now, though, I think the clear picture is value, biotechs, energy has already kind of made a lot of the move. A rotation out of the more speculative high growth names. It's been consistent across every single one that I've talked to.
Yeah. Well, again, we really appreciate you jumping on with us this morning. 007, same to you. Guru, any quick parting words as we have 10 seconds until the bell rings?
Well, I'm super happy that we keep finding these gems where people come in and show us their way of seeing things. And thank you very much for sharing that with us and your generosity this morning. It's been a pleasure to have you on board.
Yeah,
Stop
1,000%.
thanking me. I appreciate everybody else here too. I mean, it's all about just kind of getting together and between all of us doing what a hedge fund does and figuring out what the right answer is. I think what you're seeing right now is in a normal environment, we would open up like we just did, and you would gap down that big, and we would immediately start testing higher. And which I'm not saying it won't at some point, but the first reaction has been to sell on the open. So that's not telling of a very pretty picture. One of my mentors used to say that he would always, before buying options, he'd always watch the first 15 minutes, see where things shake out. Outside of that, a lot of times you're guessing because you don't know how the billions of dollars are being allocated on the open. So that's a good example of this is why you don't run out and do what has worked in the past, because it doesn't always work the next day.
Well, stick around, folks. Kyle, thanks for being with us. Please don't be shy to share. I know you haven't been, but thank you very much for sharing in chat. People really enjoy it. Well, I'll speak for myself. I really enjoy it. So stick around. 007 again, thanks. JTW, thank you very much again. And we will see you all on Thursday morning.
Yep.
Yeah.
Have a great day, everybody.
All right, take care, guys.
Have a good one, folks.